Let's talk more about that stupendously horrific data and specifically today's jobs report. Bring in Steve Liesman. Steve, great to have you with us. We've been sort of throwing this around with the traders already about the notion that this could be the worst in terms of job losses. Is that what you're hearing from economists, or should we be expecting another wave? Because obviously the first waves were the lower paying jobs. And are we now going to get into the cycle where we see the professionals, the higher paying jobs, and potentially a bigger hit to the economy?
It's a definite possibility, Melissa. You would get to a point where, well, if there's nobody to boss around, what do you need the boss for? It's possible this goes into, say, a white-collar round of layoffs as well. Just as an example, the unemployment rate for those with less than a high school diploma is above 21%. For those with a bachelor's degree or higher, is just 8.4%. You would think that would be more your managerial class, those with the college degrees. So they have really been just affected a little bit by this. But I just want to come back to one thing, Melissa, this idea of the Fed put. The Fed put is in a totally different place from where it's ever been. The Fed put was always thought of, well, if the market goes down a lot, the Fed will lower interest rates, and that lower interest rate will filter through and help the stock market. The Fed put in this case is this coming corporate bond facility. The Fed has a put on equities in the sense that if the Fed wasn't in there buying bonds and those bonds went into default, the equity could be wiped out. The Fed doesn't have to buy stocks here because effectively the Fed has put a floor under stocks. And to me, when I think about why this market's rallying, it's that guarantee, essentially, that the equity won't be wiped out because the debt won't go bad. That's a huge part of this rally in the markets.
It's extraordinary, Steve, to think that this is a blanket debt guarantee for corporate America, and the Fed has not yet spent a single penny on it. And yet here we are in terms of results when it comes to the high yield market as well as the equities market. But what happens, Steve, with this blanket debt guarantee? What happens when the Fed is left holding the bag? If this lasts longer, if it's not just a short-term liquidity crunch, it's not just a short-term period of recession, and there's no snapback recovery, things are more protracted, and as you say, companies do in fact see their equity wiped out.
Melissa, I just want to apologize if I made you think it's a blanket guarantee. It's not a blanket guarantee. There are some restrictions on it. I believe it's 4-year debt and lower. It's not everybody, and it's obviously not all speculative grade debt. They're not going to be out there buying that, but they will buy some, especially the fallen angels. I don't know what happens when the Fed, if it should perhaps be end up an owner of these things. We haven't seen all the rules yet for this program. I thought it was going to be announced this week. I'm not sure why it wasn't. I'm almost certain it'll happen next week. And you are right about the powerful effect it's had in the corporate bond market. You've had companies like Boeing come to market. All kinds of companies have been raising money, which is a good thing.
Some
it
companies
helps to
that
liquefy the market. Yeah, SeaWorld.
Norwegian, UAL. I mean, the list goes on and on and on here. I think Guy has a question, actually. Sorry to interrupt you, Steve.
Hey, Steve, thanks for sticking around. So there's been a lot of chatter, a lot written about potentially negative interest rates in the United States. Inside the Fed, I know you're not there, but I know you know people. What are their views on potentially negative interest rates here in the United States?
Negative interest rates gets a double thumbs down from all of the people I know at the Federal Reserve. I think there are so many things they would do before they went to negative interest rates that they haven't even thought about the things they would do before they go to negative interest rates. I don't think they're going there, at least not right now. They may be forced there, but it really gets back to the conversation you had, and apologies to Melissa, why she even brought me on the show, which is this jobs market story. There is a debate out there right now, and debate number one is this is over, this is the worst of it. I have some people even saying you may see positive employment in May based on their upbeat beliefs about what happens with the reopenings. Got other economists saying to me, look, there's another 10, 12, 15 million Americans who may lose their job, and that's from a second wave of economic job losses that could come. First wave was because restaurants shut down. The second wave is going to happen because, the restaurant suppliers didn't have the restaurants to supply. That's an economic wave. You see that in these lousy jobs numbers. If we get to a place where more is needed, you could imagine the Fed could increase these programs, Guy. You could imagine they could make the rules easier than they are already. That would be all stuff that would come before the Fed went negative, I believe.
Steve, just to be clear, we have you on this show because we love speaking to you. Have a great weekend.
Thank you.
Yes.
Steve
Thank you.
Liesman. It sounds like it could be a market-moving event when the Fed actually releases the rules by which they will follow their corporate bond buying program, Brian Kelly. And I'm wondering if there's two reasons why there might be pressure. It could be the rules and the release of the rules, getting some more clarity on that. But also, when the Fed starts buying, should you be selling to the Fed, basically?
Yeah, so the short answer is yes, or the answer to your second question is yes. There is an awful lot of hedge fund money, speculative money that have bought up corporate bonds that are just waiting to plug the Fed. And what we're talking about here, exactly what you brought up, there's a huge difference between liquidity and solvency. Liquidity gets you over the hump until the economy gets opening up again. But if that economy isn't robust enough, then you have a solvency issue and the Fed will be holding the bag. Now, again, we can print as much money as possible. The printer will go brr and just keep printing the money. So I'm not terribly worried about it. But I do think that the market has not priced in the potential for insolvencies.